Here's a 10,000 piece puzzle I was working on a few days ago. Now I got all the way down to the last puzzle piece and I couldn't find it. It's missing from the board, so I frantically scattered all around my house looking for about 4 or 5 hours just for this one last piece. Now I put in about 6-7 hours in the rest of the pieces, and then this one final piece I put about 3 or 4 hours into. I eventually found it in the couch, but it was a long process that took a lot of effort and is not really necessary. Now I'm going to explain to you how I could have saved myself hours and hours of time and energy by using a concept that auditors call materiality. I'm Andrew Harton, and if you listen up to this presentation, it could help you in your accounting career and in any auditing you do on large-scale clients. Now materiality, how does that apply to this puzzle incident? Materiality is any level of doubt that you're able to give in an audit opinion to save yourself time and effort in your work. So for instance, I was able to get 9,999 puzzle pieces correct. And was it really necessary for me to get that one last puzzle piece? Or did I really have a strong picture and did I know what the puzzle was supposed to look like? Now in my presentation today, I'm going to go over planning materiality, then I'm going to tell you what a tolerable misstatement is, and I'm finally going to conclude with aggregated misstatements and how those can affect an audit opinion. So planning materiality, by definition, is the maximum amount of total dollar value that the overall financial statements can be off, and it will not affect the decisions of the users of the financial statements. So what this means is, for instance, if overall planning materiality was established at $100,000, that means that if accounts receivable, accounts payable, any sort of large account or line item is off by $100,000, it will not affect the usefulness of the financial statements to the users, and it will not affect their decisions. Now there are multiple ways to establish planning materiality, one of which is to use 5% of pre-tax income. That's a very quantitative measure, so auditors also have to keep track of qualitative measures like the current economic environment, what industry the company is in, and many other ones. Tolerable misstatement, by definition, is the amount of planning materiality that is allocated to a single account. So for instance, if one account, one part of accounts receivable will have a different tolerable misstatement than the overall planning materiality. Now there are multiple ways of doing it. 50 to 75% of planning materiality is the most common quantitative measure. And for instance, if tolerable misstatement is $50,000, what that means is that one account can be off by $50,000 and it will not affect the users who are looking at the financial statements. And finally, we have aggregated misstatements. Now when you bring all of your tolerable misstatements all together into one final number, there can be two possibilities. First off, the misstatements will be below planning materiality, which proves that it is below planning materiality. It will not affect the user's decisions who are using the financial statements. So, as an auditor, you can issue the opinion that the financial statements are adequate and available to be released to the public. However, if the aggregated misstatements are higher than the planning materiality, then there are multiple paths that an auditor can go down. First, they can ask the client to simply revise the errors in the financial statements in order to get them below planning materiality. If the client refuses to do this, what they can do is they can issue control deficiencies, significant deficiencies, and in dire cases, material weaknesses. Now what these can do is they're going to reverse the opinion from a clean opinion if the client had chosen to revise the financial statements, and rather they would give a qualified opinion or, in worst cases, an adverse opinion. Now I'm going to open up to questions about materiality.